When a nation consistently exports more than it imports, the intuitive assumption is that the country is getting rich, and by extension, its government treasury is overflowing with cash. Yet the macroeconomic data shows a deep contradiction. Many of the world's most dominant export economies simultaneously run massive, persistent fiscal deficits. This presents an accounting paradox. How can a sovereign state look structurally broke on its own balance sheet while simultaneously accumulating vast amounts of global capital? The answer lies in a foundational macroeconomic identity equation. Private savings minus investment plus tax revenue minus government spending equals exports minus imports. Let's break those variables down. S minus I is the private sector's net savings. T minus G is the government's fiscal balance. And X minus M is the national trade balance. Because this equation must balance, if a country has a massive trade surplus on the right side and a massive government deficit on the left, the private sector savings must expand exponentially to cover both. A trade surplus does not directly deposit cash into the state treasury. It enriches the private sector, the exporting corporations and their workers, while the government often borrows to sustain domestic infrastructure. To harness that accumulated private wealth and translate it into state power, the government relies on specific financial mechanisms engineered by its central bank. When a trade surplus and a government deficit exist at the same time, the standard indicators of economic distress are flipped, turning a state's debt into a mirror of its citizens' private wealth. Consider the physical starting point of global trade. An exporter ships goods to a foreign buyer and receives 100 million US dollars. But that exporter cannot pay their factory workers, utility bills, or domestic taxes in foreign currency. They require the local tender to survive. To solve this, the exporter deposits the $100 million into a domestic commercial bank. In exchange, their account is credited with the equivalent amount of local currency. The commercial bank now holds a massive dollar position. Holding too much foreign currency exposes the bank to severe exchange rate risk, forcing them to offload those dollars to the ultimate buyer of last resort, the nation's central bank. When the central bank acquires that $100 million, it records it on its ledger as a new asset, foreign exchange reserves. To balance this, it creates a corresponding liability, digitally minting new local currency and crediting the commercial bank. In a trade surplus nation, the central bank must monetize incoming foreign exchange, digitalizing foreign capital into a new supply of domestic money. This forced money creation generates two opposing economic forces simultaneously. The local currency loses purchasing power at home, yet gains purchasing power abroad. Domestically, the central bank's forced printing expands the local money supply against a relatively fixed supply of domestic goods, driving up prices. Globally, the math runs in reverse. International demand to buy the country's exports outpaces the new supply of local currency, driving the exchange rate up on the world market. The resulting inflation does not impact the population equally. The divergence is explained by an economic concept known as the Cantillon effect. Export firms receive the newly minted currency first. They deploy this fresh capital to buy assets before price increases ripple through the broader economy. The citizens holding static cash balances absorb the damage. By the time the new money reaches them, the prices of goods and services have already adjusted upward. This dynamic acts as a hidden tax, silently transferring wealth from domestic savers directly to the export sector and the state. If the central bank continuously printed money to absorb an endless stream of export dollars, the resulting hyperinflation would destroy the domestic economy. To stop this, the Ministry of Finance executes a defense mechanism known as sterilization. The government issues sovereign bonds, essentially borrowing the newly printed local currency back from the private sector to lock it out of circulation. This borrowing explains why the government runs a massive fiscal deficit despite the nation's trade wealth. The state is purposefully taking on debt to quarantine the domestic money supply. The central bank still holds billions in US dollars. The ultimate release valve is the sovereign wealth fund. The Treasury uses its borrowed local currency to buy dollars from the central bank, injecting that foreign capital into the fund. The sovereign wealth fund operates as the final physical barrier in this chain, intercepting foreign capital and recycling it back into global markets through investments in foreign equities, infrastructure, or debt. These funds serve as a macro hedge, ensuring that foreign investment returns are captured while protecting the domestic economy from imported inflation. The fragility of this system is exposed when the flow reverses, during a sudden trade deficit or a panic of capital flight. Importers and fleeing investors suddenly demand US dollars. The central bank is forced to sell off its foreign exchange reserves, taking back local currency in the process. To maintain parity on its balance sheet, the central bank is mathematically required to permanently destroy or retire the local currency it reabsorbs. A critical failure state, known as debt monetization, occurs if the central bank refuses to destroy this currency and instead hands it back to the government to spend, creating liabilities entirely devoid of asset backing. Creating unbacked currency while capital actively flows out of the country severs the mathematical anchor of the money, triggering an immediate collapse in sovereign credibility. This dynamic exposes a rigid hierarchy in the global financial system. We can classify the world's currencies into a fiat pyramid, based entirely on the quality of the collateral backing their central banks. Tier 3 represents the standard model for most developing and export-driven nations. They must hold US dollars and foreign exchange reserves as collateral to legitimately issue their own money. Below that is Tier 4, the failure state. These are nations lacking export productivity, whose domestic debt is entirely rejected by global markets, trapping them in economic isolation. This brings us to the concept of original sin. If a Tier 4 central bank expands its balance sheet by purchasing its own untrusted domestic debt, it prints money backed by nothing. North Korea is a textbook example of this failure state. Because they lack foreign exchange reserves and global credibility, the North Korean won has no external anchor. The result is a dual-track economy. The official local currency is forced upon citizens, while the actual black market operates entirely on smuggled foreign collateral, like the US dollar or the Chinese renminbi. Without global demand for a nation's exports to provide foreign exchange collateral, a domestic currency is merely a local illusion enforced by the state, rejected by the rest of the world. If we move to the top of the pyramid, we have to ask why the ultimate currency issuers do not require foreign exchange reserves to back their printing. Tier 2 consists of the European Central Bank and the Bank of Japan. They hold the privilege of printing currency backed entirely by their own massive, highly liquid domestic bond markets. But the undisputed apex of this system, Tier 1, is the United States Federal Reserve. The mechanism of U.S. hegemony is straightforward. The Federal Reserve prints U.S. dollars backed strictly by U.S. government debt, because U.S. treasuries are universally accepted as the global risk-free asset. By issuing the global reserve currency against its own debt, the United States effectively socializes the inflationary cost of its money printing across the entire globe. While the United States can print against the abstract promise of its own future, everyone else must earn their collateral through hard exports and rigorous sterilization. Within this rigid hierarchy, sovereign wealth funds and FX reserves serve as the mandatory collateral for monetary sovereignty, a high-cost entry fee for any nation not permitted to borrow indefinitely in its own name.